For over a decade, borrowing was cheap and easy, fueling growth, optimism, and a sense that the good times would never end. But now, interest rates are high. The era of easy money is over, and the cost of borrowing has surged. This isn't just about banks or investors. It's about your job, your home, your future. The rules have changed. By the end of this video, you'll see the economy and your place in it very differently. So, how did we get here? One word: inflation. Central banks raise interest rates to fight rising prices, making borrowing more expensive and slowing the economy. But if they cut rates too soon, inflation could come roaring back. If they keep them high, recession looms. They're walking a tightrope, and the whole world is watching. High rates hit home, literally. Mortgages, car loans, and credit card debt all cost more, putting home ownership and even basic purchases out of reach for many. People spend less, delay big decisions, and feel less wealthy. This quiet squeeze slows the economy long before any official recession is declared. It's a personal recession happening in millions of households right now. The housing market is frozen. High mortgage rates have priced out buyers, but sellers are locked into low rates and won't move. Transactions have collapsed. Buyers can't afford to buy, sellers can't afford to sell. Builders are slowing down, worsening the housing shortage. Renters get squeezed hardest as more people are forced to rent, driving up prices. The result: gridlock, frustration, and a market stuck in place. High rates hit businesses too. Borrowing to grow is suddenly expensive, so companies cut back on expansion, hiring, and investment. Small businesses feel it first, but even big companies are slashing costs and laying off workers. The focus shifts from growth to survival. The business world becomes cautious, defensive, and less dynamic. Job security takes a hit. Employers are cautious. Raises and promotions slow, and layoffs become more common. Workers cling to their jobs, afraid to risk a move. The Great Resignation is over. Now, it's the Great Stay. The job market feels stagnant, and career growth stalls. For investors, the game has changed. With safe returns from bonds and savings accounts, risky stocks lose their appeal. Speculative bubbles deflate. Only companies with real profits survive. Volatility rises, and investors shift to defense, seeking steady, reliable returns. It's back to basics. Patience, quality, and fundamentals matter again. The era of easy gains is over. Governments are feeling the pain too. Years of cheap borrowing led to massive debts, but now interest payments are soaring. Choices are tough: raise taxes, cut spending, or borrow even more. None are easy, and the political battles will be fierce. The debt reckoning is here, and it affects us all. But not everyone loses. Savers finally earn real returns, and those without debt are insulated from rising costs. Financial discipline is rewarded. Patience and prudence pay off. Investors with cash can buy assets at a discount when others are forced to sell. In this new world, adaptation is key. The patient and prepared will thrive. So how do you win in a high-rate world? Embrace disciplined budget, pay down debt, and build an emergency fund. Be patient. Opportunities take time to appear. Invest for the long term. Focus on quality, and don't panic during downturns. Financial literacy is essential. Understand how rates affect your life. Take control, make smart decisions, and shape your own financial destiny. That's how you stay ahead. The era of cheap money is over, but this isn't a message of despair. Adaptation, discipline, and knowledge are your best tools. Manage debt, build savings, and invest wisely to build real financial strength. The future isn't set in stone. You can prepare for it. Want to stay ahead of the next shift? Subscribe to the Finance Room. The next financial change won't wait for anyone.